Good morning, everyone. Thank you for joining our webinar, Revolutionize Accounts Receivable Using AI. I'm Sharon Payne, the Product Manager for Integrated Receivables. Today, we are excited to showcase our vendor partnership with Fidelity Information Services, FIS, to provide an innovative receivable solution that we can now offer our clients. I'm thrilled to introduce our presenter, Keith Coward from FIS. Keith will share valuable insights on the role of AI in receivables management. With over 25 years of experience in leveraging technology to enhance processes, Keith is not only the owner of receivables at FIS, but also a seasoned practitioner. We will leave at the end of the presentation for a Q&A session. So without further ado, I'll hand it over to Keith.
Great. Thanks, Sharon. Hi, everybody. As Sharon mentioned, my background and experience really, now with FIS, I'm the global market owner, but before that, I was previously running credit collections and using our receivables product, as well as experience in accounts payable and different parts of the payables process and record to report or general accounting. So lots of experience as a practitioner in large global companies and shared service centers. So I'll be speaking more about my experience as a practitioner, more so than what my current role is today. So I love statistics. I like to start out with some numbers just to give some gravity to what we're going to be talking about. So we always ask, what are the top challenges that everybody's facing? And you can see on the left-hand side of the screen here, 42% of CFOs identified that managing and reducing DSO is a critical priority. And a lot of that has to do with the interest rates increasing, so the cost of capital becomes more expensive. And so they're looking for ways to improve their working capital and fund their business from within their own processes versus potentially borrowing more capital. And then 67% of the CFOs reported having no automation in their AR processes. So they want to reduce DSO, and it is a critical priority for them. However, everything they're doing is manual. So those two things certainly don't go hand in hand. So they're looking for ways to automate and even leverage AI in their processes to help them improve. So what is the problem that they're facing? So manual processes, they're slow, certainly open them up for errors, manual errors, keying errors, things like that. With having more resources than what may be necessary, if you had some automation in place, it's definitely cost intensive. And then ultimately they're lacking visibility. So if everything's being done manually, they have no centralized place to be able to see what work's been assigned, what's been executed, and certainly where they can make improvements. So by leveraging AI, the Office of the CFO is really focusing on a few key areas. One is efficiency. So being able to do more work with fewer resources or resources that are then assigned into more strategic areas. Being able to leverage the data that they have, because all of the experience you have with your own customers really provides predictive insights. And we're going to talk about that a little bit later on. And just visibility and the mitigation of risk. So every company has a different threshold of how much risk they're willing to take in terms of doing business with their customers. So just having visibility to it certainly is important information, but then being able to take steps to mitigate that risk is also very important. Obviously, as we mentioned, they're wanting to reduce their day sales outstanding, or DSO. And then again, that allows them to reallocate their resources into more strategic areas or more strategic actions. So it gets rid of a lot of the administrative work that companies are doing if they have manual processes. And so AI provides the insight and really helps companies to improve cash flow. And it makes them more confident and allows them to make better decisions and make decisions quicker than if they were doing things manually. So I like to take people through sort of the evolution of what we've seen in the receivable space. So 1950s is a relative term. Obviously, collections started well before that, but it gives you an idea of kind of how things started. Everything's manual, paper-based. The collections process was generally based on whatever the largest invoices were in terms of value and the oldest invoices. And that really produced cyclical results for companies because they were focusing on those larger dollar or older invoices. If they were to collect on that large dollar invoice, the results would look great for a month, but then all the smaller dollar invoices they didn't get to tend to add up over time, and then they go back into the trough, and that's kind of what the cyclical results means. So then companies started to move into leveraging strategies and some level of automation. So that helped to reduce administrative tasks, that they were able to leverage automation to take care of some of those tasks. But it helped them to standardize their processes. And that was really important because especially if you have multiple ERP systems, trying to standardize what you do across those systems is quite difficult. And then this is where they started to leverage and introduce the idea of customer risk. So rather than focusing on the largest dollar invoices or the oldest invoices, started to look at how much risk is associated with that customer. What is the level of risk that they're going to become delinquent or that they're not going to pay for those invoices? And so by layering this in, it started to improve cash flow for companies. It was still a reactive approach, and results, while they improved, they tended to plateau over time. So they'd see an improvement in the results, and then once they hit a certain point, it kind of leveled out, and they really didn't see that continuous improvement. So that's where AI comes in. So what AI is doing across the receivables or credit to cash process is that it's predicting the future risk of the customers. So based on the experience that you have with those customers in the past, it's able to predict 60, 90 days into the future if that customer is likely to go delinquent. And I'm going to walk you through how that happens in kind of a practical example in just a moment. And really, what AI does is it provides the optimal level of efficiency and effectiveness. And the best part about it is that it's constantly adapting. So it's not with the strategies and automation, you got the ramp up period and then it plateaued. But with AI, it's constantly adapting to what's changing in the marketplace. Is the risk changing with individual customers or in the entire portfolio? So this is what creates that continuous cash flow improvement for companies. And it really puts you in more of a proactive approach to the collections process and helping to reduce DSO. And it even potentially identifies new revenue opportunities. You can do this by looking at customers that are shown as a low risk, predicted to be a low risk, but maybe they're underutilizing their credit lines. So you could potentially offer larger credit lines out to those customers so they become sales targets for your sales teams to be able to helpfully grow revenue for the company as well. So if we look at how AI is leveraged across the entire receivables process, and the credit scoring side of things, so that's generally upfront when you're onboarding a customer or reviewing the creditworthiness of a customer. You have the scoring based on if you have past experience with them or potentially pulling in data from outside resources, credit bureaus like Dun& Bradstreet or Experian, Equifax, so on, to pull that data together and in essence create a scorecard for those customers. So based on whatever your threshold or level of risk that you're willing to accept, you can automate a large portion of the review process and only send the exceptions for approval. And then automatically adjusting strategies in the collections process. This is a really big one. So it's using risk-based collections so that instead of focusing again on the larger dollar or older invoices, it's really looking at the risk of potential delinquency for customers and automatically moving them into the appropriate strategies. So you may have multiple strategies set up for high risk customer versus a medium risk or a low risk or some level of in between. And so you want to treat those a little bit different. So the higher risk customers, you want to make sure that you're staying on top of them, more touch points with those customers, and leveraging automation for those lower risk customers. And again, we'll walk through a practical example of this. And learning new posting methods in the cash application process. So identifying where there's an exception in that process that couldn't be matched automatically and monitoring what a user does to clear that exception, the system can learn how they applied those payments so that the next time a payment comes in, it can use that as a attempted posting method. And then being able to identify and route disputes and deductions. So typically these get identified in the cash application process. But if there's enough information to identify what the dispute or deduction is about, then it could be coded and automatically routed to the appropriate teams to resolve those disputes, which generally sits outside of the collections team. So it may go to a sales team or a billing team, services team, and so on. So being able to leverage them to reduce the cycle time associated with disputes and deductions. So what does this look like in each of those areas? So under credit management, it looks like things and along the lines of real-time order management. So if you've ever worked with sales teams, they want you to approve those credit increases or orders as quickly as possible. So it's important to have that real-time ability to review and be able to update and release those orders. Providing an online credit application, the customer risk scoring. As I said, you can automate the credit limit approval for a large portion of your customers just based on certain thresholds that you have set up in the scoring process. It does allow you to standardize your procedures and establish those review cycles. With a lot of companies, they're dealing with so many customers that they don't get to review all of their customers in a given year, or some companies like to do it, every quarter or so. It just depends on the volume they have. But they can establish these credit review cycles to make sure that they're reviewing and mitigating any potential risk and changes in the risk profile for their customers, and then alerting them to exceptions. So if something changes in a risk profile for a customer, you want to be alerted to it as soon as possible so that you can take action to prevent future delinquency or even potential write-offs. So how does AI improve cash flow and reduce risk? So there's three main pillars that make up AI in this area. So one is identification. So being able to identify the ability and propensity of a customer to pay. So the ability to pay is generally on the credit side of things. It's their credit worthiness, and the propensity to pay is their willingness to pay. So they may be very strong financially, but there may be issues in how they're paying their customers. So you want to make sure you're looking at it from both sides. And following identification, you have prioritization. So automatically organizing the accounts based on that assessed customer risk. So you want to make sure that you're focusing, as many touch points as possible on the higher risk customers, and leveraging automation on those lower risk customers. And then finally, coverage. So a lot of companies that I work with, that I've talked to, that when they're using manual processes, it's very rare for them to be able to get through a collector to be able to get through their entire portfolio in a given month. So they're only contacting, generally, again, if it's manual, the oldest invoices or the largest dollar invoices. So being able to automate that contact to some of the lower risk or self-curing accounts allows them to get through their entire portfolio, generally multiple times in a month. So I'm going to walk you through a little bit of an example here, sort of a test for you, a teaser. So if I give you 4 numbers in a sequence, can you predict what the 12th number will be after this sequence? And this is giving you sort of a visual of what AI can do and how it does it. So it's pretty tough to determine what that 12th number would be just based on these four numbers that are shown on the screen. So what if I give you the 5th number, with 6th, 7th, 8th? How about this? I'll give you the entire sequence from beginning all the way up till the 11th number after that first sequence that I gave you. So can you predict what the next number is going to be? It's pretty tough, right? So the number is 1027. And for those of you that want to know what the actual sequence is, it's you add 1, you add 2, and then you add 3 times the next odd number. So what is this actually telling you? So this is showing you a pattern. So this is what AI does, is it's looking for trends in the data to be able to predict in the future what's going to happen, so that you can then take measures to prevent that from happening, in this case, from an account going delinquent. So what does that look like from a risk scoring standpoint? So if we look at this data, which this is a real customer's data, and this is how it was broken down into different categories. So you can see the risk classification on the left-hand side of the data chart. You have different categories of extreme risk, very high, high, moderate, low, and very low. And what I want to call out here is that the blue bars on the right-hand side, so the 15.8% of their entire customer accounts accounts for 75.3% of the future risk in their entire portfolio. So BAD, or bad, stands for beyond acceptable delinquency, and that can be different for every company. It depends on what your definition is. But 75% of their accounts, 15% of their accounts equate to 75% of the risk or of accounts going beyond acceptable delinquency. And what does that equate to in cash? That 75% equates to 84.4% of the cash at risk in their entire portfolio. So by focusing most of their effort on just 15.8% of their customer accounts, they're able to address 84% of the risk of their cash at risk in their entire portfolio. That's pretty large. And then we take a look at a practical example. So what does that mean based on all that data that I just shared with you? If we have two different customers, you have customer A, they owe $50,000 and they're greater than 30 days past due. If customer B owes $30,000, but they're greater than 10 days past due. So if I ask you on the surface, which customer would you go after first? Most people would state customer A because it's a larger amount and they're more past due. However, if I tell you based on the risk profile, so the experiences you've had with this customer in the past, data from credit bureaus and so on, customer A actually scores a low risk, customer B scores as a high risk. So the probability of going beyond acceptable delinquency for customer A is 2% versus 50% for customer B. So a simple calculation tells you the cash at risk for customer A is actually $1,000, but the cash at risk for customer B is $15,000. So this is a very simplistic example, but it shows you how just based on the dollar value and age of an invoice, you could potentially be leaving money on the table. So if you focus your collectors on customer B, or the greater cash at risk with a customer, and then allow automation to help you with customer A, or the lower risk customer, that's where you're able to make the biggest impact on cash flow. So what does this look like from a collection standpoint? So based on those different categories or risk classifications for customers, you can set up different strategies associated with those categories. So this is potentially a sample high risk strategy where you might, 10 days before an invoice is due, send an email reminder of just, hey, invoices are coming due, just a proactive reminder for customers. So you give them the opportunity to respond back with things like, hey, I actually didn't receive the invoice, or for them to let you know if there's a problem with making payment. And then these are flexible timeframes, but as an example, one day after the invoice is due, send another email that says, hey, we noticed you're late. These invoices are past due. And as a best practice for companies, you really want to collect on the entire account. You don't just want to focus on one invoice that may be past due. While you're sending, a notice for invoices that are past due, also include all the invoices that are coming due. So again, you're collecting on the entire account. And then the next step in the process could be 3 days later. Let's make a phone call because we either haven't gotten a response for them or they still haven't paid. So we want to ask them, is there a problem? Is there a reason why you haven't paid yet? Is there something that we can do to help solve that problem? And then potentially 2 days after that, an email to sales letting them know, hey, warning, this customer is past due. We're not getting any response from them. So potentially we're going to put them on credit hold and might go into more aggressive collection actions. So again, this is an example of a high risk strategy, but there's flexibility in how these happen. So this allows you to use some automation and then make sure that you're getting multiple touch points to these high risk customers. So what does that look like from the collections coverage standpoint? So as I mentioned, those 3 different pillars of identification, prioritization, and now we're talking about coverage. You can see here these different categories of risk. So self-curing accounts, these are the ones that will pay regardless of whether you contact them or not. They pay routinely. Then you have low risk accounts and medium risk accounts. Generally, most accounts and customers that we work with, we see that the majority of their customers fall into these 3 categories. So that's what that green line that kind of sort of looks like a bell curve. is indicating is the number of customers accounts that we see falling into each of those categories. As soon as you move into the high risk accounts or extreme risk accounts, which hopefully you're not doing a lot of business with extremely risky customers, but it could be a strategic relationship that you have. These are the ones that you want to really focus most of your efforts on. So that's what the blue bars indicate, is the level of automation that should be used and can be used across these different categories. So the self-curing, low risk, medium risk accounts, you definitely want to use as much automation as possible. You can still use automated reminders for those higher risk accounts. But really with the extreme risk accounts, those are the ones you want your collectors calling on as much as possible and as many touch points as possible in a given month to make sure that you're heading off any potential risk of delinquency or write-offs. On the cash application side of things, there's certainly a number of challenges that we hear from a lot of clients, and that's the lack of a consolidated view of all of their payments. So more than likely, you're getting payments from checks through a lockbox, credit card payments, ACH, wire payments, and so on. But there's different ways that you can find information on those payments. So there's really not a consolidated view of everything together. It's very labor intensive and with manual processing. So generally, a lot of people on that team of applying all of these payments. And then you face just having misapplied payments. So if you do have some level of automation, which ERP systems have some automation they can provide, generally it's not very large or a large amount of automation. But it's also opens up for misapplied payments of manually applying. Someone may miskey something, but even some of the automation that's available in an ERP system may misapply a payment, which means rework. So you're having to go back and fix what the issue was. And then generally at the end of a month, there's always a cash posting backlog. So if you're not able to apply payments within 24 hours, then that's creating an issue of, at the very least on the reporting side of things, of showing that there's open invoices when they've actually already been paid by a customer. So leveraging AI in that cash application process, it certainly helps with the speed of application. So it's reducing that backlog and helps you to apply all payment methods, at the same, using the same process. Being able to leverage automatic write-offs. So with a lot of companies, they have a threshold for a small dollar write-off. So if an invoice is short paid by 50 cents, it's really not worth the time and effort of someone trying to investigate and resolve whatever that 50-cent short payment was. Just allow the system to automatically write that off to a small dollar account so that it can post the rest of the payment against the open invoices. And then, as I mentioned before, it's learning from its exceptions. So it's monitoring user action when they're clearing an exception of something that couldn't be posted automatically, so that it can then use that as a way of posting the next payment that comes in. So machine learning really does create that opportunity for continuous improvement, specifically in the cash application process. So what we generally see with most of the clients that we work with is the value that integrated receivables brings is the cash application automation. It reduces that manual work and gets rid of the rework of having to reapply payments. And most customers that we work with, they see a 5 to 15, even more than 15-day improvement in their DSO or day sales outstanding, which for a lot of companies can equate to millions of dollars in cash flow for each day of improvement in DSO. Depending on where they're starting from an overdue accounts receivable standpoint, generally we see an average of 20% or more reduction in their overdue accounts receivable. And with a lot of companies we've worked with, even if their overdue accounts receivable was fairly low, so they may have been like 94% current, come to find out that they have too many resources that are working in the collections process. So they're doing things manually just to maintain that 94% with too many resources. So they're able to reallocate those resources into different areas of the business and leverage automation to help them to even continue to improve on that 94% that they were at. So they're leveraging AI across the entire order to cash process, which ultimately all of this together combines to provide improvements in working capital and cash flow for companies, which is what all of us are looking to do. So an example of a case study, we have a global industrial manufacturing company, around 86 billion in annual revenue. They were able to reduce DSO by over 10 days and reduce overall past dues by over 25%. And that all was happening at the same time that they were increasing the amount of volume that they had in terms of revenue that they were managing. So that increased by 15%. So while increasing the workload by 15%, they were still able to reduce their overdue past due by 25%, which is a massive amount of cash flow when it equates to a company that size. And with that, I think we can open it up for questions. So Sharon, do we have any questions that may have been put through the chat? I think you're on mute, Sharon. Sorry.
So we're now opening the floor for the Q&A session. And we'll address them promptly. Do we have any questions?
Looks like there's one that's come in the chat so far. So I can go ahead and address this one. Question is, which modules have the biggest impact on cash flow and working capital? And just for clarity, the modules I'm assuming you're talking about are the kind of different areas or pillars within the order to cash process, which is credit, collections, cash application, and disputes and deductions. So in general, all of them have an impact and work together to improve working capital and cash flow. But what I could say is that the collections process really has the biggest impact from a cash flow standpoint. Because when you're talking about cash application, the payment's already in the bank. So yes, you still need to apply the payment. So there is, a minimal impact to cash flow. But really in the collections process, that's where you're driving getting payments in quicker. So you're training your customers on what you expect in terms of them paying according to terms, and you're preventing them from going delinquent. At the same time, you still have with disputes and deductions, that can be a drain on days sales outstanding, and even cash flow, because typically, as I mentioned before, they're only being identified in the cash application process. You may have a collector that hears about a dispute or deduction ahead of time when they're contacting the customer. But in the cash application process, that means that it's already gotten to the point where the invoice was due. So if you don't identify that dispute or deduction until the invoice is already past due, then you're basically starting the clock over, where you have to resolve whatever the issue is, which can take a week, 2 weeks, and a manual process could take a month or more. And then you have to make that invoice collectible again. So then you have to go out and try and collect from that customer. So it certainly has an impact. And then from the credit management side of things, certainly you're able to prevent revenue leakage by staying on top of the reviews of your customers, being able to identify the potential risk associated with those customers. But if I had to pick one, I would hands down tell you that the collections process is the main driver of improving cash flow and working capital.
Keith, we have another question. How are payments applied against invoices across multiple ERP systems?
It's a good question. So I hear that a lot from companies of, if we have multiple ERP systems and we have a payment that's coming in that cash application process, how does that payment get applied into those different ERP systems? So ultimately, within integrated receivables, we know exactly which system or ERP system each invoice comes out of. So when we have a payment that's coming in and we know which invoices it needs to be applied against, we're able to split that payment into the different ERP boxes or systems, so we can send that data back out to clear the individual invoices in each of those ERP systems. So I'll give you an example. In my past experience as a practitioner, we had 7 different ERP systems we were working out of. Most of them were SAP. We had JD Edwards and a couple of others. But being able to identify that invoice ABC came from this SAP box, invoice 123 came out of JD Edwards, and so on, we're able to take that payment and split it to apply to each of those invoices in the different ERP systems.
Okay, we have another question. How easy is it to integrate this technology to an ERP like NetSuite? And what do you think the company size needs to be for an implementation like this to make sense from a cost perspective?
Another good question. So yeah, we have experience of integrating with all the different ERP systems that are out there. Basically, I know we've done over 90 different ERP interfaces. So there's different ways of doing it. You have potentially batch file processes as well as API processes for some of those ERP systems. But in essence, it's just being able to extract the data. So it's invoice data, it's customer data, credit related data, extract that from the different ERP systems like a NetSuite. And that feeds into the integrated receivable solution. And that's where all the transacting takes place. So that's where all the work is done by collectors, cash appliers, and so on. And then that data is fed back into the ERP system. And that can be scheduled to run every night. It can be scheduled to run more frequently throughout the day. Just depends on how you want to set up your system to try and keep those in sync at any point in time.
We have another question, Keith. Which do you find more predictive, internal experience / data versus external credit bureau data?
So that is a good question, and it's one that's been debated quite a bit. So certainly internal data is extremely predictive of what you can expect or what you will be able to predict for in the future with your customers. So their past payment behavior, order history, and so on is very predictive of what's happening in that relationship with the customer. However, with external credit bureau data, you're also getting the information of how they're paying other customers or other vendors. So to me, it's actually important to include both because you may be a strategic supplier for your customer, and so they may be paying you on time every time, right up to the point where they file bankruptcy. So having that view of both internal payment history and experience, as well as the external experience that other vendors out there are having with that same customer, is important. And really combining both together is the best way to get a true overall picture of the risk.
We have another question. What is the average time for setting up the solution?
Good question. So it does depend on the complexity of a company. So it could be, if it's one ERP system, a low number of users that need to be on the system, could generally be anywhere from a month to a couple of months, just again, depending on the complexity and the ability to extract the data I mentioned earlier from the ERP system. And then if you get into a little bit more complex where you have multiple ERP systems, again, it depends on the ability of the IT team that's working on that ERP system or supporting the ERP system, for us to be able to work with them to extract the data from the different systems and get it all loaded into the integrated receivable solution. So that could take a little bit longer amount of time, but certainly it's as quick as you're able to move and help support the process. We're able to move as quickly as well.
Any other questions? Okay, this concludes today's webinar. We hope you found the session both informative and engaging. A replay of the event will be available to you to share within your organization, and it will be sent out shortly. For a demo, or if you need more information about the solution, please reach out to your Treasury Management Officer or banker. Thank you and have a great rest of your day.
Thank you.